Hey guys, it's Mrs. Invest. So we hear this all the time. A diversified portfolio is the way to go. Diversify, diversify, diversify. But is a well-diversified portfolio really the answer for everybody? I don't necessarily think that's the case, and I think there are some disadvantages of a well-diversified portfolio that really don't get talked about. But on the other hand, I do think there are certain situations where a poorly diversified portfolio could actually work out for somebody. And this is really what I want to get into in today's video. You know, a lot of this stuff is kind of nuanced and it's definitely just my opinion, so keep that in mind. So first, let's talk about what is diversification in our investment portfolio. Well, very simply, diversification is a way to manage and reduce risk with your investments. So a well-diversified portfolio means you have your money spread rather thinly across many different asset classes and many different sectors within each asset class. So for example, you may have some of your net worth tied up in real estate, which is an asset class, and some of your net worth tied up in stocks, which is another asset class. And when it comes to the stock market, a well-diversified portfolio will hold something like many different stocks, or if you want to keep it simple, you would be holding some ETFs that in themselves hold thousands and thousands of different stocks. So when you think of a well-diversified portfolio, think of many more holdings. In the case of ETFs, thousands of different stocks. Generally, those portfolios are lower volatility. The returns tend to be more predictable. You know, we generally know that historically the broad market is going to return about 10 to 12% per year on average over the long term. These portfolios tend to be a bit lower stress, and the investor of a well-diversified portfolio typically does not have a very strong emotional attachment to any of the individual of the thousands of different stocks that they're holding. You know, you're not following the quarterly reports. You're not looking at the company's financial statements multiple times per year. And on the flip side, a poorly diversified portfolio has very few holdings, maybe a few only individual stocks, or maybe even one individual stock in the case where someone goes all in. These portfolios are super volatile and the returns are also extreme. These are high risk, high reward. You have the potential for huge rewards or the potential for big losses as well. And this is why they tend to be higher stress. And you'll find that an investor in a poorly diversified portfolio has a significant emotional attachment or a philosophical attachment to the companies that they're investing in. You know, you're putting almost a good percentage of your net worth into one individual company. There's usually a reason, and you're pretty attached to the company for whatever reason, and you're following them pretty closely throughout the year, reading the financial statements and the quarterly reports. So up until about 2019, I had a pretty well diversified stock portfolio. I had a bunch of ETFs. I definitely had some individual stocks, but none of them really amounted to a large percentage of my net worth. And then in 2019, I found Tesla stock. I have two other videos on my investment in Tesla stock on my channel, so watch those if you're interested. I'm not really going to get into that here, but Tesla basically changed my entire opinion on diversification within your investment portfolio. And for me, Tesla was the company that made me okay with putting a large percentage of my net worth into a single stock. And I swore I would never do this, like never. Like for me, it was basically like, you know, if you say you're like never gonna get married, it's not for you, and then you just meet that one person that like changes everything and you run off into the sunset together. Like that was basically my affair with Tesla stock, and still is today, honestly. And so from 2019 until now, with this extremely poorly diversified portfolio that I have, I've really learned a lot about the realities of having so much of your net worth tied up into one individual company and sort of what comes with that. And that's really what I want to get into today and explain to you guys what I've learned, and also things that I think are useful for you to know if you are the type of person who would be suitable for a poorly diversified portfolio. But let me be clear here that if you choose to invest into the broad market, into ETFs that generate a pretty well documented historical return of 10 to 12% per year over the long run, you are going to do an amazing job, better than probably 80% of the population, in generating long-term wealth for yourself. But where I'm really getting in this video today is, what about that other 20% of people? Like, what are they doing? And I've always been a very curious and ambitious person, and I've always sort of looked around to figure out, what are other people doing, where I want to be in life, what are those people doing to get there? And what I realized before my investment in Tesla stock was that the people who retire off their investments at a young age, and by young I'm talking like, 30s, and specifically retire from their investments, not like they had an inheritance or whatever. Those people, I started noticing a pattern that they often invested the majority of their portfolio into very few companies, and sometimes often went all in on one individual company. And I always just took note of that in the back of my brain, but I never really did anything with it until 2019 when I found Tesla, the company. And you might be like, Mrs. Invest, wait, isn't that like a terrible idea to put all your money into one company or very few companies? And at first your gut reaction is like, yes, this is a terrible idea, you shouldn't do this. And honestly, I agree with that for the vast majority of people, but I think the answer to that question is a little bit more nuanced than that. And I think whether a poorly diversified portfolio could be right for you really depends on three main factors. Okay, number one, the most important one by far, is, do you have the stomach for poor diversification and the volatility that comes with it? And I think most people think that the hardest working part of the body when it comes to investing in the stock market or investing in any company or business is your brain. Like, as long as if I only had the knowledge and I knew what to do, I would be fine. And I've said many times in my channel here that I think the knowledge aspect of it is honestly pretty small. Like, there's not that much to learn to be able to be reasonably successful. But I think by far the hardest part is to train your stomach to handle the volatility that comes with just investing in general, but especially with a poorly diversified portfolio. And this is like a muscle, right, that takes years to train and to develop this emotional stomach for volatility. And I would say at minimum, if you're super good with your emotions, this will take you months to learn. I don't think anybody's born with it, because it's just a natural thing to panic when you see yourself losing money. This is just a natural human reaction that we all share. And so to train this out of yourself, I think minimum will take a few months if you're super have a good handle on your emotions. But I think for most people, realistically, it will take years to develop this. And some people, no matter how hard they train themselves, will never ever be able to develop this stomach, because for whatever reason, they crave certainty, they need stability with their investments. And, this type of person will become physically ill if they see themselves significantly in the red or see their money, dropping by 40%. And I think before you even consider entering in a poorly diversified portfolio or putting a large percentage of your net worth into one individual company, you need to make sure that you are not this person, because it's just not going to go well. And just with me saying this and you watching, you probably already kind of know what type of person you are, right? But I think before you even consider investing in a poorly diversified portfolio, you need to train your stomach. And for most people, this is going to take years. And if you are that type of person who just will become physically ill watching their portfolio become super volatile and get really anxious and depressed when they lose money, I really don't think a poorly diversified portfolio is for you if you are that type of person. So figure out what type of person you are. And you might say, Mrs. Invest, okay, that's great, but how do I know when I've developed my stomach for investing in general, or especially a poorly diversified portfolio? And I think a really quick litmus test for this that gives you a pretty good indication of where you are on this spectrum of how strong is your stomach is when you are super in the green in your portfolio, everything is super good, you're up on everything, do you get extremely euphoric and extremely excited? And on the contrary, when your portfolio is super in the red, which happens to everybody, at some point in their investing career, you will be down on some investments, some by a little, some by a lot. Do you get like super depressed, like the world is ending, you're just sad, maybe anxious, maybe you feel physically unwell? If you feel like that, you're probably not quite there. And I think a really good way to tell that you're getting there is no matter how green or how red you are, your like mental space is like kind of the same. You can log on and either be super green or super red, and you just kind of look at it and you're like, okay, I'm still happy with, the investments that I picked, but that's all right. And you log off and you go about your day. And if you're getting to that point, I would say your stomach is probably becoming pretty resilient. Okay, and the second main factor that I think really can determine whether a poorly diversified portfolio might be right for you is how long you've been invested in the stock market. And this is kind of like a segue from the stomach analogy. And I think everyone should start out with a well-diversified portfolio because you have no idea what you're doing. You haven't developed your stomach yet. And if you go in on individual stocks without experience, tends to be when people start making poor emotional decisions with their investments. So I think as I say many times, I don't think there's really many things you can say that are 100% true for 100% of people 100% of the time. But I think starting out with a well-diversified portfolio is probably one of those things that's true for almost everybody. And over time, as you gain your knowledge and your stomach, you can concentrate yourself down into whichever investments are meaningful to you. And the third factor that can determine if a poorly diversified portfolio could be right for you is if you are able to identify early innovation. And what I mean by this is a poorly diversified portfolio only really works out financially if you pick right. Like if you pick the right company to invest a lot of your money in. And definitely a lot of this has to do with luck and kind of being at the right place in life and able to invest at a time when one of these super early innovative companies is just getting going. But if you are able to identify these companies, there's serious potential here to 10x, 100x, even maybe 1000x your initial investment. But you have to be looking for it. And the other main thing is you need to be able to identify this company before most everyone else has. You have to be looking for it. You have to have a curious mind. These types of companies don't just fall into your lap. And honestly, when you invest in them, at the best time to invest in these early innovators, at the time, it almost seems like insane to invest that much money into that company. Like it almost feels wrong at the time, but you have to just kind of go off your gut that this could be the next big thing. And again, I'm not advising that this is a good strategy for most people. I'm just saying that in cases where you think you're that type of person who's very curious and good at identifying early innovation, you can use that to your advantage to get in early on a company that will be the next big thing. And really that one investment can change your life. Okay, and quickly, I want to talk about retirement planning or early retirement planning with a poorly diversified portfolio, because I feel like nobody really talks about this at all. And with a poorly diversified portfolio, it becomes extremely difficult to plan for your retirement or have any type of plan at all. And that's why I said earlier, if you're one of these people who really craves a plan, like, when you go on a trip, you need to have like a plan of which hotel you're staying at, what activities you're doing every day, like a complete itinerary. If you're that type of person who needs that plan, a poorly diversified portfolio may not be for you, because it's going to be really hard to plan for your retirement because, number one, you don't even know if this company that you've gone big in is going to take off the way that you think it's going to. And number two, you don't know when that's going to happen. these companies tend to have really long bases where they just kind of trade sideways for many, many years before they break out, and you don't really know when that breakout is going to happen and if it's going to happen, when it's going to happen, and how big it's going to be. So you really don't know what kind of returns you're going to be able to expect given a certain time frame, which makes it really hard to plan your retirement. And on the other hand, if you have a well-diversified portfolio, which financial advisors love because it helps them to plan your retirement out for you. If you know that, historically, the broad market has returned 10 to 12%, it becomes a lot easier to plan out when you'll retire based on how much you have today in your portfolio and how much you're going to be adding monthly until your retirement date. So I think that's something to keep in mind. As I said in the beginning of the video, the stress factor with poorly diversified portfolios is much, much higher for this reason. You're basically kind of flying on the seat of your pants, and it's definitely not for everybody. So let me know your thoughts on diversification, about poor or well-diversified portfolios, and what you guys think. I would love to hear about it. Thank you for watching, and I will see you guys in my next video. Bye.